Okay, let's continue with mergers and acquisitions. I'll move to question 5, where we learn something called as weighted average swap ratio. We'll move to question 5. Go through the question. Go through question 5. Go through question 5. Go through question 5. Go through question 5 and let's start putting the data in that format. Go through 5 and start putting the data in that format. Go through question 5. Start putting the data in this format, that is PAT, number of shares, EPS, P multiple, MPS, number of shares and market cap. Put the information in this format. Guys, you come to the front then. There are places to be occupied here. Just come to the front. Go through the question. Go through the question and start putting the data in that format. Number of shares 2015. Market cap 1500. The format will take you to the answer 1000 and 1500. P multiple is given 10 and 5. P multiple is 10 and 5. Get this data, then we'll see what is the requirement of the question. We'll first put the information in this format and then we'll see what is the requirement of the question and then try to do that. My initial part would focus on this format only in any question. So get this data. It may answer few things asked in the question. Some we may have to calculate. This is the base data. Base data captured for two entities, E limited and H limited. Base data for the two entities. They either be a function of division or multiplication. The format will take you to the answer. There's nothing much to learn there. Now let's look at the question. Calculate the following: market price per share done, earnings per share also done, and book value per share. So the extra part which is asked is book value per share. What is book value is share capital plus reserves and surplus divided by number of shares. Share capital plus reserves and surplus divided by number of shares. If you have any fictitious assets, you will have to remove them. In effect, it's net worth. Basically, net worth of the company divided by number of shares. Next, in this format itself, book value per share, book value per share, book value per share, which is share capital 20 into 10, share capital 20 into 10, share capital plus reserves and surplus 20 into 10 plus 600, share capital plus reserves and surplus divided by number of shares. Share capital plus reserves and surplus 20 into 10 plus 600 divided by 20. Equity share capital plus reserves and surplus divided by number of shares. $15 into 10 plus 330 divided by 15, 32 rupees. This is the base data. This is the base data for the company. Now once we are done with the base data, they've asked for, now listen, the board of directors of both the companies have decided to give a fair deal to the shareholder. Accordingly, the weights are decided 40%, 25% and 35% for earnings, book value and market price. So when I'm going to allot shares, I'm going to allot shares based on multiple parameters. I will allot shares based on book value, based on earnings, based on market price. Working note 2, computation of shares to be allotted. Working note 2, computation of shares to be allotted. Shares to be allotted. Computation of shares to be allotted. Very simple. You will need 6-7 columns, so you can manage space accordingly. Parameter, base value, swap ratio. Let's first get these three. Parameter, base value and swap ratio. A merger can happen. This exchange ratio can be based on any number of parameters the question talks about. This is what I need to capture. The first parameter they are talking about is earnings, EPS, earnings, book value and market price. All have to be at a per share level. Book value per share, MPS, EPS, book value per share and market price per share. EPS, book value per share and market price share. EPS is base values are 5:20. Base values are 5:20. Base values are 5:20. MPS, the base values are 50:100. And book value, the base values are 40:32. Whatever is the base values you see here, 5:20. 50:100, 40:32. What we do is you just swap it. That's all. That is what is called a swap ratio. The swap number are 20:5, 100:50, and 32:40. This will be the exchange ratio. You just swap the values. The base values are 5:20, 50:100, 40:32. We just swap them, and it becomes 20:5, 100:50, and 32:40. Then I have something called as shares to be allotted. Now what this means is, as far as EPS is concerned, you should allot 20 shares for every 5 shares. We have to allot 20 shares for every 5 shares. How many shares are there in the other company? 15 lakhs. So my allotment is going to be 15 into 20 by 5. 20 shares for every 5 shares. 20 shares for every 5 shares. Or 100 shares for every 50 shares. 32 shares for every 40 shares. 15 into 20 by 5. 15 into 100 by 50, 15 into 100 by 50, and 15 into 32 by 40, 15 into 32 by 40. You whatever is the swap ratio, write that, multiply with 15 lakh shares which are there, into 20 by 5 into 100 by 50 into 32 by 40. Any doubts on this? Then comes the weight part and finally product. Then you will bring the weight angle here, weight, and then finally we take the product. What are the weights they have given?
Book value per share is 40 is to 32, so not 58 to 100.
The book value is 40 is to? Okay, sorry. Okay, this is MPS and this is book value per share. Okay. MPS and book value per share. What are the weights for EPS? EPS weights are 40%. MPS is, I have changed the order here. So 35 and 25. These are the weights. I have by mistake changed the order here. 40, 35 and 25. The book MPS weights are 35, book value weights are 25. Now it can be even 100 parameters they given the question. The format remains the same. Get the base values, swap the values, allot the share. If you have a weight, attach a weight to it. Finally, shares to be allotted is this. Whatever is the total of the product column, I'll end up allotting them this. I'll give them 37.5 lakh shares. I'll end up giving them 37.5 lakh shares. Indirectly, 2.5 share for every 1 share. It works out to be 2.5 shares for every 1 share. We will end up giving 37.5 lakh shares. They've asked swap ratio. You can say right swap ratio is 37.5 is to 15. The final swap ratio is a combination of 20 is to 5, 100 is to 50, 32 is to 40 is 37.5 is to 15 or 2.5 is to 1. That's the final swap ratio. It's a combination of these three, EPS, MPS and book value. A combined swap ratio is 37.5 is to 15. Any doubts on that? We'll fill the table and then answer other parts to the question. I'll add them 100 plus 300, 400. We'll just fill this table 100 plus 300. 100 plus 300, 20 plus 37.5, you get the EPS, which is some 6.9565. You can maybe work with 2 decimals also. EPS is 6.96. P multiple will continue to be 10. Price will become 69.6 or 56, whatever, it doesn't really matter. 69.6 should be the price. Number of shares will continue to be 57.5. You may get a little different answer. I have not done any rounding off here. You would have done rounding off. In effect, the price is not all this. This is of no use. The value finally is only these two. It is 100 into 10, 300 into 5, 400 into 10. The final value depends on EA, ES and P multiple. The interim division multiplication is just the company's policy. They may say that we want to do a bonus issue split, reverse split. They can do anything they want. But in effect, the value is nothing but earnings into P multiple. That's the value. Now let's look at if something else is missing. We'll calculate that. Otherwise, we'll answer it from here. Most of the things would get answered based on this. Any doubts on the table? Part 1 is done, part 2 is done, part 4 is also done, part 5 is done. 2 things are missing: promoters holding and free float market cap. Balance everything is done. Promoter holding and free float market cap is pending. 1, 2, 4 and 5 is done. 4 is coming, EPS is coming there, expected market price is also coming there. Next, promoter holding equal to Now listen, the promoter was earlier holding 9.5 and 10 lakh of these two companies. Now when it is a combined entity, he will hold 9.5 plus 10 into 2.5, because we are allotting 2.5 share for every one share, and the overall is 57.5. He will hold 9.5 plus 10 into 2.5 and the overall number is 57.5 lakh. The promoter holding is 9.5 lakh of entity 1 plus 10 into 2.5 of entity 2 whole divided by 57.5 into 100. What percentage? Exact 60. 60 percentage. The promoter holding is 60 percentage. Promoter holding is 60 percentage. Free float market cap means non-promoter holding. Sometimes the question will not give you, see, this question they gave you market capitalization. Instead of giving market cap, they can also give you free float market cap. What is free float market cap is non-promoter holding. That is, for example, if I have to analyze this entity itself, 1000 lakhs is the overall market cap. What is free float market cap is 10.5 lakh shares into 50 rupees. 10.5 lakh shares is held by non-promoters, any shareholding by non-promoter. So free float market cap is 4,000 lakh into 40%. 60% is held by promoters, balance 40% is held by public. So whatever is held by public is called as free float market cap. So the free float market cap is going to be, we had calculated the 60 percentage, balance 40 is held by public. So free float market cap is equal to 40 percentage of 4,000 lakhs. 4,000 was the combined value. You can have some rounding of difference, that's okay. Whatever number you get, you can write that. Free float market cap is equal to combined entity value into 40%, are basically non-promoter holding. It's basically non-promoter holding. 4,000 lakhs into 40%. Any doubts in this? Clear? Six is something you can manage. 7 should also be possible. 7, 8 is fine. I'll come back to some of the questions. Go through question 18. Go through 18. Go through question 18. I'll come back to few questions later on. Go through 18. Okay, most of you would have seen this problem earlier also. So now in this question, the one bank is going to acquire the other bank, and they have given 4 possible factors based on which the exchange ratio is to be decided. So what we are going to do first is, I'm going to put this data in this format: parameter, base value, swap ratio, shares to be issued, weight and product, and we'll get to know how many shares are to be allotted. Once we get the shares to be allotted, we'll then prepare the other things required in the question. Let's start. Working note 1, computation of shares to be allotted. 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 parameter base value, swap ratio, shares to be allotted, weight and product. Parameter base value, swap ratio, shares to be allotted, weight and product. We'll write the parameters they have given. Gross NPA, capital adequacy ratio, market price, book value. Gross NPA, capital adequacy ratio, market price, book value. These are the 4 parameters we have. Market price and all we'll have to calculate at a per share level. Book value also at a per share level. NPA, those are ratios. We'll write as it is. Look at the question. Somewhere you will see the NPA number. What are the NPA numbers for the 2 entities? Gross NPAs. It is acquiring company is to target company. Acquiring has what and target has what? Acquiring has 5% and target has 40%. So 5 is to 40. 5 is to 40. The company which acquires will come first. The company which is getting acquired will come second. 5 is to 40. Capital adequacy ratio 16 is to 4. 16 is to 4. 16 is to 4. Market price 128 is to 8. Book value, assume face value is 10 and calculate it. Face value is 10 and then calculate. Book value, do the calculation if face value is 10. If the face value is 10 rupees, compute the book value. If the face value is 10 rupees, what will be the book value? 120 and 15. That is 500 plus 5,500. It adds up to 6,000 and divided by 50 shares or 50 lakh shares, whatever is the number. The number of shares is 50 and 14 lakhs. And the value is going to be 6,000 by 50, 120 and 210 by 14, 15. So the numbers are 120 is to 15, 120 is to 15, 120 is to 15. Now when it comes to swap ratio, I just need to swap it. Listen for a minute. I'll do 4 is to 16, 8 is to 128, 15 is to 120. We will just swap it. But for a parameter like this, I will not do a swap, because this is a negative parameter. You have 2 types of parameters. You have a negative parameter and positive parameter. My objective would be to maximize capital adequacy ratio. My objective is to maximize market price. My objective is to maximize book value. So when I have these parameters, I get to know the company which is acquiring is a stronger company, so I swap it. 16 is to 4, I make it as 4 is to 16. 128 is to 8, I make it as 8 is to 120. But if I swap this, it will be beneficial, because 5 is to 40 will get swapped as 40 is to 5, which is not needed. Any negative parameter, they can have a ratio called as cost of goods sold ratio. If you have that ratio, you are not going to do a swap. If you have a ratio called as GP ratio, you will do a swap. Basic rule is, do I want to maximize gross NPA? No, I want to minimize it. So for all negative parameter, the concept of swap will not come into picture. Whatever is the base value will become the swap ratio. Any negative parameter. The negative parameter could be gross NPA. It could be anything, bad debt ratio, cost ratio, operating ratio. So any negative parameters, you are not going to do a swap. Beyond that, nothing much in the question. Beyond that, it's more or less the same stuff. You are going to allot 5 shares for every 40 shares, 4 shares for every 16 shares. Beyond this, nothing much will be there. The only rule is, for any negative parameter, you are not going to do a swap. The negative parameters could be multiple. One of the negative parameter in this question is NPA. They could have had another parameter called as net NPA. If they have that, that also I will not do a swap. We are now going to do a swap for any negative parameters. The other entity had 14 lakh shares, so 14 lakhs into 5 by 40. 14 lakhs into 5 by 40. 14 lakhs into 5 by 40. 14 lakhs into 4 by 16. into 8 by 128 into 15 by 120. So the ratio is available. You need to multiply with the swap ratio. 14 lakhs into 5 by 40, 4 by 16, 8 by 128 and 15 by 120. You end up multiplying it with the swap ratio. End up multiplying it with the swap ratio. Weights could be given in the question. 0.3, 0.2, so I have to give 1,75,000 shares. That's the number of shares I have to allot in this exercise. We'll have to allot 1,75,000 shares. 1,75,000 shares need to be allotted in this exercise. In the merger, we'll have to end up allotting 1,75,000 shares. They were asked for swap ratio. Swap ratio is 1,75,000 is to 14 lakhs. 175 is to 14. 1,75,000 is to 14 lakhs. Swap ratio finally is 1,75,000 is to 14 lakhs. Any doubts on this? Part 1 and part 2 is done. How many shares are to be issued? So we have already calculated that, and based on that we have done the swap ratio. Any doubts on this? Any doubts on this? Now I'll have to prepare a combined balance sheet. I'm not going to tell you to do it. Let's not waste time on preparing a balance sheet. I'll just write, balance sheet is just going to be addition of these two. It's going to be technically addition of these two. Only at this level you may see some changes. Only at this level you will see some changes. That is just purely from an accounting point of view. 500 plus 1.75 into 10 will be the paid up share capital, because you are allotting 1,75,000 shares. We are going to allot shares at book value. I'm going to allot shares at book value. What is the book value of Bank P? 120, and reserves is going to be 5,500 plus 1.75 into 110 into 110. The balance 110 is securities premium. If the balance sheet tallies, there is no goodwill or capital reserve. If it doesn't tally, then there is a goodwill or a capital reserve which comes out of the acquisition. In this problem, the balance sheet will tally at this stage, because you will acquire 210 lakh worth of company and you will end up paying consideration of also 210. So no goodwill, no capital reserve, the balance sheet is going to tally. Let's not focus more on the balance sheet side, but balance sheet is just going to be addition of all this. At share capital, you will add 1.75 into 10, and reserves and surplus you will add 1.75 into 110, the balance 110 rupees. Next, computation of capital adequacy ratio and gross NPA. Computation of capital adequacy ratio. Computation of capital adequacy ratio. Capital adequacy ratio. Adequacy ratio and gross NPA. Capital adequacy ratio and gross NPA. I know the capital adequacy ratio for two individual entities. Somewhere I have to technically take something called as a weighted average. It's technically a weighted average. You write entity capital adequacy ratio, weight and product. Entity capital adequacy ratio, weight and product. Entity capital adequacy ratio, weight and product. I have multiple ways to do it, so this is the approach I'm going to do. Entity capital adequacy ratio, weight and product. We have bank R, bank P, bank R, bank P and merged. Bank R, bank P and merged. Bank R, bank P and merged. The capital adequacy ratio of bank R is 4%. Bank P is 16%. Somewhere in between 4 and 16 is going to be the answer. Somewhere in between 4 and 16 is going to be the answer. Now, the format works in such a way that your second column into third column should add up to product. That is how we do. Second into third is the product. The formula for capital adequacy ratio they have given. Capital adequacy ratio by capital risk weight asset ratio. Okay, the formula is not directly given here. Capital adequacy ratio basically tells that the capital of the company as a proportion of the risk weighted assets. So in banking, accounting for banking companies, you could have learnt about something called as risk weights. So based on the assets risk weight, the companies, the banks are required to maintain some capital. In case of company 1 or the bank R, it's only 4%. What is the net worth of bank R? How much is the net worth you see? Net worth is share capital plus reserve surplus. 210. Second bank? 6,000. Listen for a minute. My capital adequacy ratio, this weight is nothing but in this case risk weighted assets. It's technically risk weighted assets for this problem, and this product is nothing but net worth. So what happens is risk weighted assets, net worth divided by risk weighted assets is capital adequacy ratio. If you do a reverse working, net worth divided by risk weighted assets is capital adequacy ratio. Capital adequacy ratio into risk weighted assets is technically net worth. So I'm just using the same formula in a different way. Capital adequacy ratio into the risk weighted assets is net worth of the company. Our net worth divided by capital adequacy ratio is the risk weighted assets. You can call it in multiple ways. Once I get this, I'll add these two, and this is division. 6210 divided by second column into third column has to be the fourth column. That's the approach. Column 2 into column 3 is column 4. Capital adequacy ratio is equal to fourth column divided by third column. The formula for, you can write the formula for capital adequacy ratio maybe. Capital adequacy ratio is net worth divided by risk weighted assets. Capital adequacy ratio is net worth divided by risk weighted assets. Capital adequacy ratio is net worth divided by risk weighted assets. So I have written risk weighted assets in the third column and multiplied the second and the third column to get the net worth. My final capital adequacy ratio number is this, 14.53. The capital adequacy ratio is going to be 14.53. It's going to be 14.53. Whatever is the formula, the denominator will be the third column, the numerator is going to be the fourth column. So the denominator is the third column and numerator is the fourth column. In effect, I want column 2 into column 3 to be the last column. That has to be maintained. Same thing I'll again do. Entity gross NPA percentage. We'll decide what should be the 2 points. Entity gross NPA percentage. Any doubts on the capital adequacy ratio calculation? If you know the formula, your whatever is the denominator, that technically becomes the third column. Net worth is the fourth column. You need not even remember the format and all. Very clear. Second and the third column, when I multiply, I need to get to that fourth column. That's how we have devised this. What will be the formula for gross NPA percentage? If at all I have to calculate this percentage. Yeah, NPA by advances. So this column is advances and the last column is gross NPA. The third column is advances, fourth column is gross NPA. You will have the figures in the question. You fill it, you will get to the answer. The third column is, the formula is gross NPA percentage is equal. Like this, you can keep doing any number of ratios. NPA by advances. Advances will be the third column and NPA will be the fourth column. I basically need, when I multiply the second and third column, I should get the fourth column. That's the rule. So that rule has to be maintained. The question will have data, you can write them and then get the answer. Entity, GNPA percentages, advances and again GNPA. gross NPA percentage, advances and gross NPA. Bank R had a GNPA of how much? 40%, 5%. Advances of bank R was 3,500, 27,000. GNPA number is, that's all, 9.02%. The format will take you to the answer 9.02%. 9.02%. You write the formula in the side. This the only thing is you'll have to write the formula once. After writing the formula, you can finally say merged has a 9.02%. Whatever formats I give, I will understand it, but somebody may not understand it. So whatever answer you get in the end, you just write saying that EPS is equal to so much, MPS is equal to so much, because they may have to search your table because they may not be very clear with this format. So whatever answer you are getting, if you get that 9.02, if I just read this line, maybe someone else can find it difficult to understand. After you are done with it, finally you can write in gross NP of merged bank is equal to 9.02%. Capital adequacy ratio of merged bank is equal to 14.53%. Below the table, just write that. That is sufficient. Any doubts on this?
Capital reserve. The share capital of Rock totals to 140 plus 72 10. Against it, we have allotted only shares for 17.5 and capital reserves 192.3.
No, so it's technically securities. I've added, so we are adding it to reserves and surplus. Let's not worry about it. Your capital reserve will also go to your reserves and surplus. Yeah, so net it will add up to the net worth, that I am sure. The point is they have mentioned that shares will be allotted at book value, or somewhere they had mentioned this book value. Just a minute. It was decided to issue shares at book value of bank P. So book value is 120. The book value is 120, so balance is securities premium, or you call it as capital reserve. Hardly matters from a ratio calculation point of view. Just give me a minute. Let's do this question 13. Go through question 13. Go through 13 and put it in that format itself. That format will answer few things. We'll see the rest. Go through 13 and put the data in that format. Particulars and that company name, try to put it in that format. You will get some information. Rest we will see how to we calculate. Put the data in this format, we will end up getting some information. We'll see the balance in some time. The free float market cap is 19.2 crores, which is 16% of the company. The free float is non-promoter holding. So if you divide by 16%, you will get the entire 100% value. 1920 divided by 16%, you will get the overall value. And shares also 63 lakh divided by 84%. 84% is 63 lakh shares. If you divide by 84%, you will get the overall value again. Balance is fine, more of a formality. The balance part is more of a formality, nothing much is there. The P multiple is 25 times. P multiple is 25 times. It is just in the format you will get to the answer, so be clear on that. The interlinkages, sometimes I'll start from PAT, sometimes I'll start from market value, sometimes we start from EPS. We can go with anything. Net, either you take the number below that or above that and try to get the missing info. Any doubts in this? Now they are saying, as per the SEBI guidelines, promoters have to restrict their holding to 75% to avoid delisting from the stock exchange. Board of Directors has decided not to delist the company, but to by issuing bonus share to minority shareholders while maintaining the same P ratio. Now what they are saying is, we are going to, instead of how normally in a practical world it will happen is, promoters will sell some shares. Now the promoters are saying, I am not going to sell some shares, but I am going to allot some shares to the minority shareholder so that my holding comes down to 75%. Now this is same triple limited, I write it again. After this what will happen is, this will become 63 by 75%. It will become 63 divided by 75%. When you divide by 75%, you will get to know the overall shares which should be there, because these guys are now going to hold only 75% of the company. Balance things will remain same. Your number of shares will go up, no impact on the value and all. Your MPS again becomes a balancing figure, P multiple remains same, EPS changes. So what is going to happen is, instead of having 63 by 84%, now it will become 63 by 75%. And you can recreate the same table. With these two tables, will answer whatever is asked in the question. Most of the information will come from these two tables. Earlier it was 63 by 75%. Now it is 63 by 84%. Now it has become divided by 75. 63 lakh by 84%, 63 lakh by 75%, by 84% and by 75%. By 84 and by 75. Divided by 84% and divided by 75%. It's a very simple area. M&A will fall the easiest of the lot. Mutual funds and M&A should be the easier of the lot. Both will carry a weightage of 1/4 of your paper. Put together it will carry 1/4 of the weightage. In old syllabus it is 1/3 of the weightage, both put together. So in new syllabus it will be 1/3 weightage, old syllabus will be 1/4 weightage. These two areas put together. Any doubts on this? No, because your market value depends on PAT or it depends on P multiple. If you don't, now it will change now. The free float market cap will change now, because you have allotted more shares to your minority shareholder. See, the point is, market cap can change only with these two, PAT or P multiple. Suddenly company will say, I will do a bonus of 1:1. This will become 168. EPS will come down. MPS will come down, value will remain same. So my value never changes just because I'm going to do a bonus issue. Clear? Any doubts on this? We have answered this. These two are answered. P ratio, market price of share before and after the issue of bonus share. The before was 160, after is 142.85. Any doubts on this? Next, free float market cap after bonus issue equal to, free float market cap after bonus issue equal to 12,000 into 25%. Free float market cap after bonus issue is equal to 12,000 into, indirectly promoters are losing something and the minority shareholders are gaining. Practically this will not happen because you will end up selling the shares. Why will you give free shares to minority shareholder? You will sell the shares in the market rather than giving free shares to minority shareholder. 12,000 into 25%. So the free float market cap will go up now to 3,000 or 30 crores. From 19.2 crores, it will go up to 30 crores. Any doubts on this? Next, bonus ratio is equal to, bonus ratio is equal to, how many more shares we allotted? 9. How many shares were there earlier with minorities? 12. So 9 is to 12 is the bonus ratio. You allot 9 lakh shares to 12 lakh shareholders. We have allotted extra 9 lakh shares. Extra 9 is 84 minus 75. And they were earlier holding only 12 lakh shares. So now 12 has gone up to 21. It's free shares given to them. 12 has gone up to 21. 12 has gone up to 21. Now a similar question came in exam, but institute unfortunately missed to give this number. The promoter holding was missed in the question, and in your solution they had assumed a promoter holding and gone ahead with the solution. So you will see all those challenges in paper. So if at all you are confident on a question, go ahead and make your assumption. The requirement was to make an assumption and then get to the answer. Not a logical one, because that is a very critical data. Somewhere it got missed out in the exam. It got missed out. Maybe when the paper was set, somewhere it got missed out, and because of that, you will not be in a position to even proceed with the question. So that's a critical data which you have to assume and go ahead. Any doubts on this? Try question number, just a minute. Try question number 8. Do question number 8. Try to do this question. Please do question 8. Do question number 8. Do question 8. Read it, read it. EPS for cabbage and cauliflower. Cabbage is 3 and cauliflower. They have changed the company names at this stage. They were earlier giving cauliflower and cabbage. At that stage, they have changed the company names to cabbage and cauliflower. So you'll have to be careful. You will have to be careful about these aspects. So it is not what given in the question. It has to be swapped at that stage. 5 and 3. These are very small adjustments like this. Some hidden adjustments can keep. There's a very small adjustment. There's nothing great, but it's just that in that flow you'll end up writing it. You will have to read it carefully. Let me know if there are any doubts. It's again that format driven answer. Most of the exam questions will fall in this category, if at all it's on the swap ratio side. Any question on the swap ratio side will mostly fall in that format. The number of shares allotted in scenario 1 is 3:5. The base values are 5:3. The swap ratio will become 3:5. So 5 lakh plus 3 into 3 by 5 is the new shares. 5 lakh plus 3 into 3 by 5. 5 plus 3 into 3 by 5 plus 3 into 3 by 5. Other side is 5 plus 3 into 1 by 2. 5 plus 3 into 1 by 2. 5 plus 3 into 1 by 2. They've asked only EPS, but anyway we have done that entire computation. The requirement was only till EPS. With that itself it is sufficient. The requirement of the question is just to compute at an EPS level. If not certain of what will be the requirement, you try doing the entire part and then start answering it. You will mostly get most of the parts answered in this. Now, this is a different question where they've asked, state the impact on EPS for the shareholders of two companies under both alternative. Their specific requirement is EPS. If they just ask gain or loss, then I would have done this format itself. Yeah. So what we are going to do is, I'm going to use this. The only thing is, instead of writing price per share, I'll write earnings per share. I'm going to write earnings per share and calculate the gain or loss for the two sets of people. Instead of having it as price per share, because normally the impact is measured through price. In this question, they want the effect to be measured through earnings per share. So you can tell me these numbers. Pre-merger, what was the earnings? Post-merger, what is the earnings for entity 1, entity 2, and then we get the profit or loss. We'll do scenario 1. In scenario 1, pre-merger price EPS was 5. Post-merger is also 5. Gain or loss, nothing is there. For Cabbage Limited, pre-merger was 3. Post-merger is 5 into 3 by 5. Earlier I was holding 1 share of 3 rupees earnings. Now I hold only 0.6 share. I hold only point. In effect, if you allot based on EPS, no effect will be there. For both the set of people, there will be no effect if you are going to give the shares on the basis of EPS. If you want to find the impact on EPS and you allot based on EPS, no impact. If you want to find the impact on MPS and you allot based on MPS, again no impact. So whatever is the basis, if that is the basis and you are trying to find the impact on that, you will not see any impact being there in that question. Unless they say P multiple changes or the earnings changes. That's a different scenario altogether. If I allot based on book value and I say pre-merger book value, post-merger book value, both will remain same. Pre-merger book value and post-merger book value is going to remain same if you allot based on book value. So if the basis of allotment and the impact is same, if you are trying to analyze it that way, you will see 0 as the answer. So if I am allotting based on EPS and I want to find the impact on EPS, if I want to find the impact on MPS, I can see an answer. There is a possible impact on MPS, but there will be no impact on EPS. Second part was pre-merger was 5 rupees, post-merger it became 5.23. So there is a gain here. It became 5.23 and this was 5.23 into 3 by 5. 1 by 2, sorry. Into 1 by 2, into 1 by 2, and the impact is some point negative it will have. Yeah, it will have a negative impact. 0.385. Basically what is happening is one guy's earnings is being enjoyed by the other person. That is why you see one positive impact and one negative impact. One shareholder's loss is being taken away as a benefit by the other set of shareholders. That's how the ratio has been designed. In this ratio, one guy will gain, the other guy is going to lose. Any doubts on this? Any doubts on this? Do question 14. Do question 14. Do question 14. All these are your exam questions only. Do question 14. Do this question 14. Now, if you look at this question, they have given two entities, LMN and XYZ. This is the base data of the two entities. I would ideally do a merger analysis at this stage. They ask me this data, and when they want me to analyze merger, they're suddenly changing the P ratio. When the merger analysis is to be done, they have changed the P ratio of XYZ. That's what is given in the question. So I have done another column called as XYZ modified, or XYZ as per part 2 of the question. As per part 2 of the question, they have changed the P multiple, and then the analysis is continued. Part 1, they have not even asked any analysis to be done. So when I come to part 2 of the question, they have changed the P multiple for one of the entity. They have changed the P multiple for one of the entity, and based on that they are saying you calculate exchange ratio, what is the post merger EPS. So based on that number they want us to do the analysis. Ideally I would do it on these two numbers, but the question when it comes to the second part, they have changed the P multiple to 9.6, and the proposal is to do it on the basis of current market value. Market value means your exchange ratio will be based on MPS. If this 9.6 was missing in the question, my exchange ratio will be based on this 30:15. You will swap it and make it as 15:30. Because they have changed in the part 2 of the question, my exchange ratio will, in fact this data is of no use now for the time being, that whatever was original data that answers part 1 of the question, but beyond that I cannot use that data. Now my exchange ratio will be based on 30:9.6. The exchange ratio will be on the basis of 30:9.6, which is the base value. You will swap it and make it as 9.6:30. This is because specific requirement of the question. When it comes to part 2, they have suddenly changed the P multiple, and original number is not used in any analysis. So even if you prepare a merged one, then you will have to again do this, because in the rework part they have changed the P multiple, and now I will get a merged based on these two. The in between XYZ is of no use. That XYZ, whatever you would have originally calculated, that would be of no use for the time being, because data has undergone a change. The in between, whatever you would have calculated, ideally you would have done this, you would have got this 15 and all. This data I cannot use it now, because they have changed the P multiple. They have ended up changing the P multiple. So my merged is 6 plus 1.6, 3 plus 1.6 into my allotment will happen in the ratio of 9.6:30. The base values are 30:9.6. Allotment will happen on the ratio of 9.6:30. So into 9.6 divided by 30. That's the requirement of the question. The question has changed the numbers. 9.6:30. Let's work with 4 decimal. My post merger EPS is 2.164. Post merger EPS is 2.164. If I want, I can fill this table. If I'm filling this table, I'll work with this 15 itself. Anyway, the question doesn't want anything beyond this, so that you can look at the question. If at all you want to fill the table, or you don't want any confusion, complete the table and then start answering whatever way you are comfortable. I continue with this 15. MPS will become 32.46, and the value is some 114 lakhs. The value is basically 114 lakhs. The value is 114 lakhs. Any doubts on this? Any doubts on this part? We have answered part 2 of the question. Part 3 says what should be the exchange ratio if pre-merger and post-merger EPS are to be same. Now I am not going to do any calculation here. My exchange ratio should be based on this. If my exchange ratio is based on EPS, the pre-merger and post-merger, that is, if I do 2:1, that is, it will become 1/2. If you do 1 by 2, you will get the same EPS. You will end up getting the same EPS. If the exchange ratio is on the basis of EPS, then the pre-merger and post-merger EPS would remain same. If the exchange ratio is on the basis of MPS, then pre-merger and post-merger MPS would remain same. So different parameters can be there. So now write part 3. LMN can maintain, LMN Limited can maintain its EPS, can maintain its EPS if the exchange ratio is on the basis of EPS. If the exchange ratio is on the basis of EPS, base value is equal to this, swap ratio, you swap it and write the value. Base value is equal to this, and then once you swap it, you will get the swap ratio. Go through question 15 and start putting the data in the same format. It will have a little bit of extra analysis on ROE. I'll take you through that, but put the data in that format itself. Question 15, put the data in the same format. This would have been your base data that answers one part of question A, which is EPS and P component. Decompose the share price of both the companies into EPS and P component. We have done that. That will answer one part of the question, EPS and P component. Now, also segregate the EPS into ROE and book value. Now, return on equity, the formula is earnings available to equity shareholder by value of equity, or earnings per share if you calculate at a per share level, and book value per share. So if you do at an overall level, it is called as EAES by value of equity. If you are doing at a single share level, it's called as EPS by book value. In short, EPS is equal to ROE into book value. EPS is equal to ROE into book value per share. Your earnings per share is a multiplication of return on equity and book value. The other side of the formula will become this. EPS is nothing but ROE into book value per share. Now in that table, I'll have to write book value per share. You look at the data and tell me what is the book value per share. Reserves and surplus plus share capital divided by number of shares. Reserves and surplus 12 and 10, and ROE is earnings per share by book value per share into 100. Earnings per share by book value per share into 100. Return on equity, so basically EPS, that's a three-way formula. You can end up writing it as ROE is equal to EPS by this, or EPS is equal to ROE into this, or book value. So you can get any of the numbers. ROE is 22.21 and 15.6. ROE is 22.21 and 15.6. So I have my market price, which can be split into EPS and PE. EPS can be split into ROE and book value per share. So you can keep dividing this, and finally you can get at a ROE and book value per share. Any doubts on this? The formula is this, the base formula is this. ROE is equal to EPS by book value per share. Return on equity is equal to earnings per share divided by book value per share. Any doubts on this? Clear? Can you proceed? Now, based on estimate the EPS growth rate. What is the formula for growth rate? Retention ratio into return on equity, or IRR. I have return on equity. Next I'll write retention ratio, and I get the growth. ROE is already available. Retention ratio, and then we get to growth. Retention ratio and then growth. Retention is 80% and 70%, and growth is multiplication of these two, 17.77 and 10.92. Growth is 17.77 and 10.92. That's the growth the entity is going to have. Any doubts on this? Now listen, we are done with this too. This is slightly a tricky area. Based on expected operating synergy, R Limited estimate the intrinsic value. Intrinsic is the real worth of the company, which is 25 per share on its acquisition. You are required to develop a range of justifiable equity share exchange ratio that can be offered by R Limited to S Limited. Now, the exchange can happen based on multiple parameters. It can happen on the basis of EPS, it can happen on the basis of MPS, it can happen on the basis of growth rates, it can happen on the basis of the intrinsic values. In this question, Institute has taken one basis as this, 50:20, that's the base value. You will swap and get the answer. The second is based on the intrinsic value, which is 25. this entity in absence of information will continue to be 50. The intrinsic value and the market value in the absence of info will continue to be 50. So I have two exchange ratio. One exchange ratio is, you need not write, you just understand this. One exchange ratio is going to be 20:50. That's based on the market price. Second exchange ratio is 25:50. This is based on intrinsic value. In the absence of info, the intrinsic value of company A or the first company continues to be 50. This is lower limit. Why lower? 0.4:1. This is upper limit, 0.5:1. The lower limit is 20:50 or 0.4:1, and upper limit is 0.5:1. 20:50, 25:50. So you have a lower limit which is 0.4 share for every 1 share, and upper limit is 0.5 share for every 1 share. Now they are saying, will the negotiated terms be closer to the upper or the lower limit? It will be, see, when any negotiation happens between two parties, it will be closer to the upper limit. If, for example, I want to sell a property, I am asking for 1 crore, you are telling 80 lakhs. If I am a stronger person, the price will be closer to 1 crore. If you become a stronger person, you will buy it at a closer to 80 lakh rupees. So I want to sell at 1 crore, you want to buy at 80 lakh rupees. Now the negotiation will keep happening. Now I want to buy the company by paying 0.4 shares. You want to sell it at the ratio of 0.5:1. So which is a stronger company I have to identify. It's not necessary that acquiring company is always stronger. Sometimes even the company which is a target, they can be a stronger company, but because of circumstances an acquisition happens. Whichever company has better ROE, better growth rates, better P multiple, or that entity is considered to be a stronger company because their performance metrics are better. So between the two entities, whichever is stronger, if the acquiring company is stronger, then it will be closer to 0.4:1. If the target company is stronger, it will be equal to 0.5:1. I want to sell my property, you want to buy the property, price will be closer to 1 crore if I am a stronger person. Price will be closer to 80 lakhs if you have a better hand. So it depends on who wants to sell it, who wants to come out of the quickly. So depends on those circumstances. In this case, the stronger company will turn out to be R Limited because they have a better ROE, they have a better growth rate, they have a better P multiple. So this is a stronger company, and my final exchange ratio will be closer to 0.4:1. It will not be closer to 0.5:1. It's going to be closer to 0.4:1. The reason for the answers are available in printed form, so you can see it later on. I'll send you the material and all. Now focus more on the understanding part, so I can focus more on the understanding part. So you have two possible ways. One is on the basis of market price, second is on the basis of intrinsic value. Market price base values are 50:20. Intrinsic value, because of info gap, I continue it as 50. Because of info gap, I continue it as 50, and the ratio is 50:25. Apart from this, can there be other ratios? Yes, you can go ahead with EPS also. Institute has just given these two approaches, so I'm just explaining you these two. But if I'm going to solve this for the first time, if I've not seen the solution, I may end up even writing different ratios, because I can even do it on the basis of earnings per share, I can do it on the basis of book value per share, I can do it on the basis of market price per share. So there are multiple possible approaches to the answer. Institute has taken an approach of market price and intrinsic value. These are the two approaches they have taken, and in that two approaches, 0.4:1 is the lower limit, 0.5:1 is the upper limit, and my final terms will be closer to 0.4:1. Why 0.4? Because the company which is acquiring is a stronger company. I am a stronger company and I am acquiring a property. So when you sell it, you will have to sell it at a lower price. Clear? Any doubts in this? Let's do one more problem and then I go to valuation.
First part,
yeah.
you asked EPS to be segregated into ROE and book value.
Correct.
Should be in rupee terms, right?
No, ROE is always a ratio. So that why they have said into ROE and book values, EPS is equal to ROE percentage into book value per share. When you multiply with that percentage, it becomes the earnings itself. Let's do this question 11. Go through this question. Go through 11. Go through 11 and then I'll proceed to valuation part. Go through 11. switch off. Okay, I'll start explaining this. It's going to be slightly different from the normal format. Current earnings, number of shares, I write here EPS. EPS is 13, 6 crore 50 lakhs by 50, and 240 by 15 is going to be 16 rupees. The earnings per share is 16 rupees. 20% is the retained earnings, 80% is the retained earnings, so balance is the dividend. So with this you can get the dividend. They have asked for existing share price of Hankey Limited and Shankey Limited. On which formula will you get the share price? Which formula can you use to get the share price? It's a formula driven answer, no P multiple.
D1 divided.
Yeah, you will use the Gordon's formula, D1 by KE minus G. This is cost of equity. This is the cost of equity, return required by equity shareholders. This and this combined together can give you the growth rate. You will combine these two and get the growth rate somewhere. And you will use the formula called as D1 by KE minus G. Working note 1, computation of share price. Computation of share price. Computation of share price. Analysis of Hankey Limited, analysis of, or we'll do it together itself, particulars in 2 columns, particulars in 2 columns, particulars in 2 columns. In fact, in sometime this will also come, the merged will also come into picture. Particulars in 2 columns, particulars in 2 columns. Earnings per share, earnings per share, earnings per share, earnings per share is 13 and 16. Earnings per share is 13 and 16. Earnings per share is 13 and 16. Per share is 13 and 16. Dividend payout ratio, dividend payout ratio, dividend payout ratio 80% and 20%, dividend payout ratio 80% and 20%. Retention is given, percentage of retained earnings, 80 and 20 is the dividend payout ratio. Dividend per share in bracket D0, this has just been paid. They have mentioned below the table, dividend has just been paid by the company. Dividend per share D0, dividend per share D0, 10.4 and 3.2, dividend per share 10.4 and 3.2, 10.4 and 3.2, dividend per share is 10.4 and 3.2. I'll add the growth rate to it when I have to do the calculation. D0 I have done, plus growth rate will give me D1. I need KE minus G, cost of equity. Cost of equity for this first entity is 21%. Return required by equity shareholder, that's your cost of equity, 21%. Return required by equity shareholders, 21%. and 24%. Cost of equity 21% and 24%. 21% and 24%. Next item is what? Growth rate. Growth rate, the two numbers which you need are there in the question itself. Retained earnings and return on investment. 20 into 15% is 3%. 80 into 15% is 12%. Growth rate 3% and 12%. Value per share. D1 into 1 plus growth rate. D1 into 1 plus growth rate. D1 into 1 plus growth, sorry, D0, it's basically D0 into 1 plus growth rate. $10.4 plus 3% divided by 18%. 10.4 plus 3% divided by 18%. 10.4 plus 3% divided by 18%. 3.2 plus 12% divided by 12. 24 minus 12. Any doubts on this? Okay. Now listen, when I do a merged calculation, it happens like this. You need total earnings, number of shares. You can add the total earnings of two entity, but you cannot add the EPS of two entity and call it as merged earnings. I can only add the total earnings. I cannot be adding the EPS level because EPS is something which can't be added, but total earnings is something which we can add. So I'm going to get the merged valuation based on the total earnings. What are the total earnings of this first entity? 650, 240, and there is a synergy gain of something they mentioned. Now listen, though I call it as earnings per share, I'm writing it here. What I write for the merged entity is the overall value, not at a per share level. 650 lakhs plus, you can write in this format itself, 650 lakhs plus 240 lakhs plus 85. All these are overall value, not a single share value. All this is overall value. 650 plus 240 plus 85 lakh because of economies of scale. The merged entity has a different payout ratio. They have mentioned in the question. How much? What is the 65%? Hankey Limited plans to adopt a policy of retaining 35% of earnings after the takeover. So this is going to become 65%. See, whether you do calculation at a single share level or at an overall level, the answer is going to remain same. If you do at a single share level, you get the MPS. If you do at an overall level, you get the overall value. So 65%. This is the overall dividend. 633.75 is the overall dividends of the company. 633.75 lakhs will be the overall dividends. 633.75 lakhs is going to be the overall dividends. Because for the merged entity, I don't have the number of shares data. So that's why I'm not getting into the shares information as of now. They've asked only the market value. Find the value of the company after the takeover. So I don't have anyway the data on the number of shares, and I don't need it also. In fact, this number of shares information is of no use at all. I should work only at the overall earnings level, get the P multiple, get the value. Our overall dividends, divide by K minus G and get the value. So we have got the overall dividends. What's the cost of equity of the merged entity? 20%. Return required to equity shareholders will be 20%. 20% is the cost of equity, and the growth rate is 17 into 35, 5.95%. You apply the same formula, you will get the overall answer. When you apply the same formula, you end up getting the overall answer. You will end up applying the same formula, you will get the value for the overall entity, 4,779 lakhs. I end up getting the answer for the overall merged entity. Whatever is this last column, technically I should be writing these here, not earnings per share. This is total earnings, total dividends and total value. So whether you do at a per share level or you do at a overall level, it doesn't matter. If you do at a per share level, finally you will multiply with the number of shares. If you do at a overall level, divide by the number of shares. So answer is 4779.06 lakhs. Now I'll just explain one concept in this question. I don't have a separate problem to explain that, which is called as minimum exchange ratio and maximum exchange ratio. I'll just explain that here. The overall value of this first entity is 2,975. The overall value of the Shanky Limited is 597.4 and the merged entity is 4,779.4. Now there's something called as a minimum consideration and a maximum consideration. It goes back to a concept called as transfer pricing in costing. There is something called as a minimum exchange ratio and a maximum exchange ratio. When I sell this building, I need some minimum consideration. When you are buying the building, you will say that the maximum price you can pay is this much. So I need a minimum amount. You are talking about a maximum amount. If my minimum is 100 lakhs and your maximum is 80 lakhs, transaction will not pass through, because you are saying you will pay a maximum of 80 lakhs and I need a minimum of 100 lakhs. If my minimum, in this case, my minimum is 597.4 lakh. Maximum which you would want to pay is this minus this. Why you want to pay this much is because the value goes up to this extent. So you are ready to pay 1803 lakhs. I would need a minimum of 597 lakh. We will negotiate and try to fix somewhere in between. So the minimum I need is 597. If I am selling my company to you, you should pay me minimum 597 lakhs. When I am acquiring the company, I can afford to pay a maximum of 1803. This is what I can afford to pay you. If then we negotiate and decide somewhere in between. If we decide somewhere in between, one party, both the parties will gain. If it's closer to 597, the second entity will not gain and only the first entity is going. See, in this process, there is a benefit of this much. This benefit who wants to enjoy is what we are going to see. So the minimum is 597, maximum is 1803. If the benefit is not there, no, assume this was some 2500. If this was some 2500 and if the benefit is not there, you will have a negative here and you will say you need minimum 2500. He will say I can pay you maximum of 1803. In effect, the difference between minimum and maximum is the synergy gain. The difference between the minimum consideration and maximum consideration is the synergy gain. So if at all there is a synergy gain, then only there is a scope for a transaction. Next, calculation of minimum exchange ratio and maximum exchange ratio. Calculation of minimum exchange ratio and maximum exchange ratio. You just write this value alone, the overall value write and then come to calculation of minimum exchange ratio and maximum exchange ratio. Minimum exchange ratio and maximum exchange ratio. Minimum exchange ratio and maximum exchange ratio. Part 1, minimum exchange ratio.
The overall value, I believe, is for 15 lakhs. I should be able to calculate.
How many shares are there? Sorry. Okay, that's a mistake from my end. Into 15. Yeah, this will be 2975448. Here the question has only asked for maximum amount, but we'll do both minimum as well as maximum amount. Minimum is from the point of view of this entity Maximum is from the point of view of who is buying the building. If I'm buying the building, I'll talk about the maximum amount. If you are selling the building, you will talk about the minimum amount you need. So minimum exchange ratio hyphen from Shanky Limited's point of view, minimum exchange ratio from S Limited's point of view, from S Limited's point of view. Point number 1, minimum purchase consideration. Minimum purchase consideration. Minimum purchase consideration 448.05. Minimum purchase consideration 448.05. Now this is in lakhs. I'll have to convert this into shares. To convert into shares, you need the post-merger price. You cannot work with the pre-merger price. I need the post-merger price, which as of now I will not have, because my post-merger price will depend on how many shares I allot. It will depend on how many shares I allot. So point number 2, value of merged entity. Value of merged entity 4779.06 lakhs. 4779.06 lakhs. Now listen, the merged entity will be held by 2 people, shareholding by S Limited shareholders, that is the selling company, and by H Limited shareholders. This will be finally held by 2 set of people moment the merger happens. What I am trying to tell here is, once the merger happens, I should hold 448 divided by 4779 of the merged entity. Of that 4779, 448 should be my value, balance can be the other set of value. They can take the balance value. I should hold 448 by 4779. At least give me that holding. Balance the other entity can hold. Can you tell me 448 divided by 4779 is how much? 9. Listen for a minute. 9.37%. And they can hold 90.63% of the company. I don't have a problem with that. Those set of people can hold 90.63% of the company. I want to hold at least 9.37% of the company. Those set of people have 50 lakh shares. I will be given new shares now. I'll be given new shares. So I want to hold 9.37% of the company. They can hold balance 90.63% of the company. I don't have a problem with that. Let them hold 90.63%. Their value will go up. My value will remain stagnant. This is the minimum I need. So 90.63 is equal to 50 lakh. You can tell me this number. This is the shares to be allotted. 5 point. So based on that, you can get the exchange ratio. 5.17 is to 15. If I have to go to the exchange ratio part, 5.17 lakh shares will be allotted. I can end up allotting 5.17 lakh shares to the other set of people. 5.17 lakh shares can be allotted to the other people. I just want to hold 9.37% of the merged entity. Balance, let it be with them. I'm not bothered about it. Minimum, just give me this 9.37% holding. Anything above that is a bonus for me. Now, if I do this calculation, this is just to understand, 55.17 will be the number of shares. The share price will become some 86 rupees, and I'll get a consideration of this into 5.17. This will be my value. My value is 447. That's difference is rounding of difference. If at all this happens, the number of shares will be 55. Share price will touch 86, and my consideration is going to be 447 lakh, which matches with the consideration I wanted. So for minimum exchange ratio, you will do this max. Minimum purchase consideration, value of the merged entity, how much holding you want, how much holding the other person wants, and you have the share. One of the 2 shares will be available. Either it's 50 lakh available or the other one available, and then you get to the answer. Any doubts on this? Any doubts on this? Clear? Next, maximum purchase consideration. Maximum purchase consideration. Maximum purchase consideration from buying company's point of view. Maximum purchase consideration. You can write in bracket 4779 minus 2975. That is post merger value minus pre merger value. Because of merger, what is the benefit I get? Because of the merger, the benefit I get is what I am calculating here. 4779 minus 2975. 4779 minus 2975. Value is 1355.51. 1355.51. What happened? Sorry. Okay. I've done a calculation mistake here. 1803.56. Overall value 4779.06. Same calculation. Earlier you wanted to pay a consideration of some 500 lakhs. Now you want to pay a consideration of some 1803 lakhs. 4779.06. S limited holding, H limited holding, S limited holding, H limited holding. Now you want to give a slightly higher holding to the other person because you are ready to pay a higher consideration. Now the consideration is 1803. So I can pay a consideration of 1803, which means they should hold this proportion of the company. 1803 divided by 4779. What percentage? 37 point? And I can continue to hold only 62.26. I need to hold only 62.26. This is equal to 50 lakhs. This is what? This many number of shares I will allot to them. 62.26 is equal to 50 lakhs. I will allot shares based on that. How much? So I can allot a huge number because the transaction seems to be, well, this is the range. The range is from 5 lakh shares till 30 lakh shares they can negotiate. From 5 lakh shares till 30 lakh shares you can negotiate. Anything below or above will not, the transaction will not pass through. Any ratio above 30 lakhs or any ratio below 5 lakhs, the transaction will not pass through. Any doubts on this? There are few more problems which you try to manage at home in this area. The important part is most of your M&A questions, in exam questions, I know this is what gets repeated. Your most probable focus is going to be only on getting the EPS, getting the MPS, getting the PE multiple, and then deciding the base values, deciding the swap ratio. So somewhere that format will come into picture. Or they may ask a weighted average swap ratio. If it's weighted average, when it comes to weighted average, what is going to happen is you will write individual parameters, write the swap value, multiply, get the product. Only thing is when you do weighted average swap ratio or even individual swap ratio, if you have a negative parameter, there alone you should not do a swap of that. Any positive parameters, you go ahead and do a swap. Okay, now coming to the second part, which is valuation of business. Now when it comes to valuation, we have three basic approaches to valuation. One, I can value a company on the basis of assets, technically called as net assets method. You add all assets, deduct all liabilities. Again, what you did in mutual funds, you are going to repeat here, and it works with replacement value or the market value, no book value purpose and all. I'm not going to get into book value and saying that. I'm not going to give a benefit of, you will have to give all benefits of appreciation in prices, all that have to be factored in, and then you get to the value of the asset. So one is net assets method. Earnings based is nothing but your P multiple. Get the earnings, multiply it with P multiple. Sometimes instead of giving P multiple, they'll give something called as capitalization factor, which is nothing but like 1 by P multiple. So if they give you P multiple, multiply. If they give you capitalization factor, you will have to divide it. And then you have cash flow based valuation. In cash flow based, you will have two approaches. One is called as FCFF, free cash flow to the firm. Second is called as FCFE, free cash flow to equity shareholders. We will mostly be doing FCFF computation. After getting the FCFF, you will discount the cash flows and get to the value of the firm. Now, the rules of cash flow computation will be same as what you do in capital budgeting. In capital budgeting, if something is relevant, here also it will become relevant. If something becomes irrelevant there, here also it will become irrelevant. Now, what does FCFF and FCFE is? When you calculate cash flows, you calculate basically the cash flow for the owners of the company. Now, one approach says owners of the company are only equity shareholder. The second approach says owners of the company are equity shareholders, preference shareholders, debenture holders, all are owners of the company. Even if I give a loan, technically I am interested in the good performance of the company, so I am also like a owner of the company. Whatever approach you follow, if you are following an approach where owner is only equity shareholder, then any cash flow which happens between the company and equity shareholder is ignored. Any cash flow which happens between the company and equity shareholder. What cash flow happens? Dividend, buyback of shares, new issue of shares. These are the only three things which can happen between a company and a equity shareholder. If you are doing for equity shareholder, ignore these three items, which is equity dividend, buyback of shares, issue of new shares. If you are doing it for the firm as a whole, then you will have to ignore interest payment, preference dividend payment, repayment of loans, new loans taken. Basically any cash flow which can happen between the owner and the company is to be ignored. According to finance, it's just transferring money from one pocket to the other pocket. So when you are doing that, you don't consider that in cash flow computation. So if you are doing FCFF approach, you will ignore interest, you will ignore dividend, you will ignore repayment of loan, you will ignore new loans taken, you will ignore issue of shares, you will ignore buyback of shares. So any cash flow which happens between the company and the owner is defined differently in different approaches. So according to FCFF, the owner is investor, stockholder, bondholders, everyone is the owner of the company. FCFE says it's only equity shareholder. So if you use FCFE approach, you will discount it at cost of equity. If you use FCFF approach, you will do cost of capital, because it is the owner of the company. So whoever is the owner of the company, for them I will do the evaluation. All problems we will first do FCFF, get to the answer and subtract the value of debt to get the value of equity. If at all I have to value the equity component. So I have three approaches: asset based, P multiple, FCFF. Beyond this, I have Gordon's model, Walter's model. So you have multiple other approaches to do evaluation. These three are predominantly used ways. Beyond this, there can be any number of approaches which I can use. Clear? Any doubts on this? Let's get into some problems on valuation front. Let's do question number 1 itself. Go through question 1. Go through question 1. Go through question 1. Go through question 1. Okay. Now, a company is planning to implement some sales strategy for the next 4 years. They want to know the value of the strategy. As per the strategy, sales will grow at 20% for the next 3 years. They are saying strategies for 4 years, but the growth is 20% for the first 3 years. Maybe 4th year it becomes stagnant. Determine if the strategy is financially viable. Now I have to value the strategy. So what we do is we first value the company as if the strategy is implemented. Then we'll again value the company if strategy is not implemented. The difference is the value of the strategy, which can be positive or negative. If it's negative, strategy is not viable. If it becomes positive, strategy is viable. Working note 1, valuation, working note 1, valuation of the company if strategy is implemented. Working note 1, valuation of company if strategy is implemented. If strategy is implemented, particulars and 4 years first. In that you can write, part 1, computation of FCFF. In this part 1, there will be 2-3 parts to this valuation. Computation of FCFF, or note 1, computation of FCFF, particulars, 4 years, year 1, year 1, 2, 3, 4, 4 years. I'll have to calculate the cash flows. Now listen, as per the new sales strategy, sales will grow at 20% per year for the next 3 years. The gross margin ratio, that is your 20% margin, would remain same. Asset turnover ratio, capital structure and income tax rate will remain unchanged. Asset turnover ratio remaining same means if turnover goes up by 20%, your assets will also go up by 20%, then only the ratio will remain same. Capital structure is basically, it's an entirely equity finance company, so they are saying they're not borrowing any money, doesn't really matter. Income tax rate will remain same. So what I'm going to do is, the sales will grow at the rate of 20%, gross margin will grow at the rate of 20%, my expenses, I assume it will be the same 10%, that's my assumption. My expenses will continue to be at the rate of 10%. So PBT is basically 10% of sales. Profit before taxes, 10% of sales. Tax is at 30% and PAT is going to be 7% of sales. In effect, if my sales grows by 20%, my PAT will also grow by 20%. If sales is growing by 20%, my profit after tax will also grow by 20%. Any doubts on that? Sales is growing by 20%, PAT will also grow by 20%. So point number 1, directly will write PAT. PAT will improve the PAT by 20%, 1400 into 120%. PAT will grow by 20%. PAT will grow by 20%. Any doubts on this? Fourth year I have remained the same amount because the growth is only for 3 years. Fourth year we have copied the same amount. Now listen, my fixed assets will also increase by 20%. Fixed assets is also going to increase by 20%. Current assets will also increase by 20%. Now they have said depreciation is to be at 10% on the value of net fixed assets at the beginning of the year. Listen, first year fixed assets is 8,000, next year fixed assets will become 9,600. It will become 9,600. I do an adjustment called as add depreciation less capex less working capital. Now the depreciation is going to be 10% of the opening net fixed assets given. So listen, if my depreciation is 800, 10% of the opening net fixed assets, what will be the capital expenditure? If depreciation is 800, what is going to be the capital expenditure? You look at these two data and tell me. capital expenditure is going to be 2400. So what I do normally is I ignore this item called as depreciation, and we just see the net increase here. This is called as net capex. What is net capex? Is capital expenditure minus depreciation. If your overall fixed assets go up, which means your capital expenditure is more than depreciation. If your overall fixed assets come down, your capital expenditure is less than depreciation. So let me not worry about the depreciation quantum. What I can indirectly do is less net capex. Net capex is going to be 20% of the fixed assets, whatever is there. That 8,000 has to go up by 20%. If that has to go up by 20%, in fact, I don't need the depreciation rate also. If depreciation was 40%, my capex would have been depreciation plus another 1,600. The capex would be 1,600 more than depreciation. The capital expenditure has to be 1,600 lakhs more than the depreciation amount. So whatever be the depreciation, I am not really bothered about it. So I am not going to write add depreciation and less overall capex. Some question we may need it, but in this question I don't need it. So I will directly deduct something called as net capex. And net capex is the net increase in fixed assets. If fixed assets is going to remain same, which means there will be depreciation and there will be same amount of additions. Depreciation is going to be there in any company. So depreciation will be there. You will say add depreciation 800, less capex 800. So there's no point in writing that add and less. So my less net capex, right? Less net capex, it's going to be whatever that 8,000 you see. 8,000 will become 9,600. 8,000 is going to become 9,600. So 9,600. I'll write this in minus. 1,600 of capex will be done. If you want to write the figures, you can write somewhere 9,600. Next year it will go up by 20%. Again by 20%. Thereafter it will remain same. It will go up by 20%. This will also go up. Yeah. Your ratio has to remain same. Asset turnover ratio. Asset turnover ratio, the formula is going to become sales by assets. So when you use this formula, if sales go up by 20%, assets will also have to go up by 20%. Otherwise, the ratio will not be maintained. So you look at the numbers. The numbers are 20,000. As of now, my ratio is 20,000 divided by 12,000. That's the asset turnover ratio. If turnover goes up, my ratio is going to remain same. The question says that asset turnover ratio will remain same. When can it remain same? If your fixed assets and current assets also go up by the same number. Otherwise, your ratio will change, no? The formula is sales by fixed assets. If sales increases, fixed asset increases. If sales decreases, fixed asset will also decrease. So this would be your working capital numbers, basically your current asset number. So this will be your fixed assets and these are your current assets number. I am not really bothered about the depreciation quantum because I'll charge depreciation and then again write it. So instead of doing all that, let's ignore the depreciation directly. Let's end up ignoring the depreciation, and my capex is last year no capex. The net capex is 0 for the last year. When you go to the last year, your net capex will become 0. Same amount of capex you have to do, no, because your fixed assets have to remain same. The ratio has to remain same. So the ratio will remain same only if the fixed assets remain same. So you charge depreciation and same amount of capital expenditure. So in practical world, in fact, when we do analysis, we normally don't look into this depreciation itself. We just look at the net increase in fixed assets. If there is a net increase in fixed assets, there is a capex done by the company. If there is a net decrease in fixed assets, there is a release of money from the fixed assets of the company. Working capital is 800 for the first, then 960, 1152 and 0. This is technically FCFF, free cash flow to the firm. It's basically PAT plus depreciation minus capex minus working capital. I have ignored the concept of depreciation here and written it as net capex. FCFF. This is the FCFF, negative 720, negative 864, negative 1036 and positive 2419. Negative for 3 years and a positive amount for the last year. Negative for 3 years and a positive amount for the last year. Any doubts on this? One important point is whenever a growth rate changes, in this question the first 3 years was 20%, fourth year is no growth. No growth does not mean the same cash flow will continue. Most of the times you will feel that fourth year there is no growth, so let me copy the third year cash flow. No, because your capex and working capital will end up impacting the number. In this question, if they had said that there is a growth of 20% for 4 years, I would have done year 5 calculation also. I would have done year 5 calculation because I need the cash flow of the year in which it stabilizes. In this case, the stabilization happens in the fourth year. They said strategy is implemented for 4 years. First 3 years you grow, fourth year you stabilize. If the growth was 20% for 4 years, then I would have calculated year 5 also. I would have calculated year 5 because beyond this it's a perpetuity. Beyond year 4, it's going to be a perpetuity. Same amount earned every year. Year 4, year 5, year 6, year 7. Every year it's going to earn the same amount. And I cannot copy the third year number for the fourth year because just because the growth has stabilized. Because most of the times these two will be the primary impacting factor. So whenever growth stabilizes, if growth stabilizes in the fourth year, calculate fourth year cash flow and don't copy the third year number. Next, part 2, valuation of firm. Part 2, valuation of firm. Valuation of firm. Year cash flow PVF DCF. Year cash flow PVF and DCF. Year cash flow PVF and DCF. Cash flow PVF and DCF. They would have given some discount rate in the question. What's the discount rate they've given? 15%. Now listen, this format I can use it to value anything. If I want to value this building, I'll put year, the cash flow which is going to come from this building, PVF at I need a return of 12%, DCF, the sum of the DCF is the value of the building. I can value a building using this. I can value my laptop. If laptop is going to generate revenues for me, I'll end up valuing my laptop saying that year, what cash flow the laptop is going to give me, PVF at the rate at which I want a return, and DCF is the intrinsic value of the laptop for me. Similarly, you can value any asset class using this format. Now, let's write the values given in the question. Year 1, what is the cash flow? Negative 720. Year 2, negative 864. Year 3 is negative 1036. Year 4 onwards, it's a perpetuity. Now, most important thing is, when you value a perpetuity, the Gordon's formula says P naught is equal to what? D1 by KE minus G. Now, the fourth year cash flow, if you use, you're going to use the fourth year cash flow to value the perpetuity. A perpetuity can be valued moment the growth stabilizes and also the cost of capital is a single cost. So, what I'm going to do is, I'm going to use the fourth year cash flow, FCF 4. I'll divide it by KE minus G, but this will give me P3 and not P4. Most of the times people end up writing it the fourth year. When you value perpetuity, you value a perpetuity year in advance. So this will give me another third year, and that third year number is 2419.2. That is fourth year cash flow divided by 15% minus 0. Divided by 15% minus 0. Your perpetuity has to be valued a year in advance. So if 2419.2 is what I'm using to value, the answer would be written in the third year. The value of that would be written in the third year. Yeah, 2419.2. The rule is P3 is equal to D4 by KE minus G. P3 is equal to D4. So you need the fourth year cash flow to calculate the value at the end of third year. Most of the times you will end up writing it in the fourth year. In a hurry, you will end up writing this in the fourth year. It's not a fourth year cash flow, it's a third year cash flow. Beyond that, it's very simple. Write the discount factors. 1 divided by 1.15. you can end up writing this. Beyond this, there's nothing there in the question. So if I implement the strategy, the value will be this. If the strategy gets implemented, we'll get a value of 8650.43. With strategy, the value is 8650.43. Any doubts on this? Any doubts on this number? Next, valuation of the firm without strategy. 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 Without strategy. When it is without strategy, the cash flows are going to be same every year. There are no growth in the cash flow. Can you tell me what will be the cash flow in first year if you don't implement the strategy? What should be the cash flow in the first year if strategy is not implemented? Look at this. If you don't implement the strategy, what will be the cash flow? PAT plus, it's only PAT. If you add depreciation, you will have to deduct the same amount of capex. Depreciation and capex is going to remain same. So it's PAT plus depreciation minus capex. Depreciation and capex is going to remain same because your overall fixed assets have to remain same. So in short, PAT is equal to CF80. In short, your PAT is going to be equal to cash flow. There's nothing wrong in adding depreciation. You add it, but then you'll have to deduct the same amount as capital expenditure. Working capital anyway will not come into picture because same current assets will continue. That is why don't focus on depreciation, focus more on net capex. Is the fixed assets going up or coming down? If fixed assets go up, capex is more than depreciation. If fixed assets come down, capex is less than depreciation. That is provided you have data on fixed assets. If you don't have data on fixed assets, then you add depreciation. They'll separately give you the capital expenditure, you keep deducting. All that is fine. So the rule is, it is PAT, add depreciation is correct, less capex is correct, less working capital is correct, but sometime I will club this depreciation and capex after PAT. Before PAT, we will normally deduct depreciation, all that we will do, but after PAT, I may sometimes club it together. Why do I club it together? It's for ease of calculation, that's all. So value of company without strategy equal to 1400 divided by 15%. It's a perpetuity. 1400 divided by 15%. 1400 divided by 15%. The number is, the strategy has some negative value, you write that value and they say strategy is not financially feasible. We are not going to implement this strategy because value only comes down. The value is declining for the company. Question 2 is similar to that. I'll then move to question 3. Any doubts on that? That was an FCFF based approach of valuation. Let's move to question 3. 2 is similar. Go through 3. Go through question 3. Go through question 3. Go through question 3. Okay, I'll come to question 3. XN Limited reported a profit of 100.32 lakhs after 34% tax. Analysis of the account reveals some extraordinary items and extraordinary loss. Some new product is going to be introduced. Compute the value of the business. Assume cost of capital to be 12%. This cost of capital to be 12%, and they have given me data on the profits of the company. Nowhere no information is available on depreciation or capital expenditure. All that is not available. This problem we are going to use the second approach called as earnings capitalization. We'll use an approach called as earnings capitalization. That is, we have three approaches: asset based, earnings based and cash flow based. Cash flow is not going to come in this question because no information on depreciation and other items in the question. So I'll do earnings capitalization. That is, I'll calculate the earnings, multiply with P multiple if I have, or divide by capitalization rate. What is the capitalization rate is? 12%. You will divide it by the capitalization rate. Now when you calculate earnings based, we have something called as future maintainable profit. You don't go by the past profits. You look at what is the future maintainable profit. So my starting point is going to be past profit. I will add certain items, deduct certain items, and then get what is called as future maintainable profit. To start doing that adjustment, I will have to first bring this to a PBT level. 100.32 after 34% tax, bring it to a PBT level, past PBT, add or less future PBT, then deduct the tax and you get future PAT. Finally, you need future. If assume no adjustment is given, then the value is 100.32 divided by 12%. If there are no adjustment, the direct answer is 100.32 lakh divided by 12%. That's the value of the firm. Now, working note 1, computation of FMP, computation of future maintainable profits. Computation of future maintainable profits. Computation of future maintainable profits, particulars calculation amount. Particulars calculation amount. Point number 1 is past PBT. My starting point is going to be past profit before tax. Past PBT. Past PBT. How will you calculate this? 100.32 divided by 66%. Past PBT. Then I'll remove all those extraordinary items, some extra data. So whatever is given, we'll try to add and subtract certain items and then get to something called as future maintainable PAT. I'll finally need something called as future maintainable PAT. What is to be done with this extraordinary item of 14 lakhs and income, extraordinary income of 14 lakhs and extraordinary loss of 5 lakh? What should we do with income? I'll subtract it because this is not going to be there in future years. So point number 2, less extraordinary income. Less extraordinary income. Less extraordinary income. This number is not going to be there in future. 14 lakhs. Add extraordinary loss. Extraordinary income is 14 lakhs. Extraordinary loss is 5 lakhs. Extraordinary loss is 5 lakhs. Apart from that, I'm going to introduce some new product that can give me some profits. So this is an additional profit which I'm going to generate in future. There's a new product which is launched. So point number 4, add profit from new product. Profit from new product. How much will this generate? How much? 34. Sorry, okay. 24. future maintainable PBT. Future maintainable PBT. This much profits is going to be maintained in future. Future maintainable PBT. Tax at 34% and future maintainable PAT. So we started with 100, but it will be the maintainable number is 110.22. The maintainable number is going to be 110.22. Any doubts in this? Any doubts in this? With this, you can either multiply with P multiple or you divide by something called as cost of capital. So point number 8, cost of capital 12%. I'll get value of business. I'll divide and get value of business 918.5. 918.5. Any doubts on 918.5? Now there is one issue in this analysis. This PAT, no, when you calculate this PAT, if you have deducted interest, in calculating PAT, then this is only value of equity directly, because the entire PAT will go to equity shareholder. If somebody says no, interest was also not deducted using FCFF approach, or any cash flow between the owner and the company were ignored, then this is value of business. Institute has taken this to be value of business, which means when you did analysis, somewhere interest and preference dividend would not have been deducted. What we will do is, after this we will deduct this. Okay, here we have only preference capital. I will deduct this value of preference and I will be left with value of equity. If I had debenture also, I would have deducted that as well. We would have deducted debenture as well as this, and the balance figure is called as value of equity. The only important point is, who is going to get this PAT? Is this amount going to debenture holder as well as equity shareholder as well as preference shareholder? Then this gives you value of the firm as a whole. If you say no, this entire amount will go only to equity shareholder, then you directly get value of equity. So you just need to ensure consistency. So my assumption is no interest was deducted, and anyway no preference dividend has also been deducted. So this number, whatever comes, it will go to three people: debenture holders, preference shareholder. They will get their amount, residual amount will come to equity shareholder. Similarly, the business is 918. Some amount will go to debenture holders, some amount will go to preference shareholders, residual will go to equity, guys. The balance will come to equity. Point number 10, less preference share capital. Preference share capital, how much? 80 lakhs. And then I get value of equity. Number of shares is 50 lakhs, no? Yes. Now there's going to be an alternate answer to this. I'll explain that alternate answer. First be done with this. I'll explain an alternate answer which can be done. Not sure what institute has done in this question, but there is a possible alternate solution also. Now listen, the possible alternate solution is, listen. The possible alternate solution is, you work with PAT, deduct the preference dividend and use the P multiple to get the answer. Not sure what has been done in the solution. I can use the P multiple and then also get a answer. So two approaches are possible. This is intrinsic value 16.77. I can as well use P multiple and get to the answer. Clear? Let's do question 6. Go through question 6 and try doing it. Please try question 6. Try the sixth question. I'm also not sure about what is to be done. I'll need to check what ICI has done, but logically speaking, it should be current period. Because that's the current P ratio. In fact, the question shouldn't have given the P ratio. The P ratio is a number which is not needed in the question. I assume ICI, if at all they have taken P multiple, they would have taken 100.32. The current, whatever that PAT given. You will start with EBIT. Your EBIT is going to be revenues minus COGS minus operating expenses, and then add a 20% to it. That will be the starting point of the question. Revenues minus COGS minus operating expenses. Let's not worry about depreciation because depreciation is already included somewhere. So I do this into 1.2. I directly then deduct the tax. I get EAT. I'm not adding back depreciation because I'm working with net capex. And the question has in fact mentioned that capex net of depreciation will grow at 15% per annum. So last year capex net of depreciation was 150 crores. It will grow at 15%, another 15%, another 15%, and in year 4 it will be 0 because your capital expenditure will be offset by depreciation. From year 4 onwards, incremental capex will be offset by depreciation, which means capital expenditure and depreciation is going to remain same. Your capex and depreciation would remain same. From the 4th year onwards, capex and depreciation would remain same. To do working capital, it's preferable to write revenue somewhere. Otherwise, there's a possibility that you'll end up making a mistake. So preferable to write revenue somewhere. 7,500 into 1.2. Working capital can become a slightly tricky part. In a hurry, you may end up making a mistake. So preferable to write revenues and working capital separately. Your working capital, yep. Cost of? Sorry, I'm not getting your question. No, so working capital is technically they're saying 25% of revenues of the company. So whatever revenue I'm earning, my working capital is 25% of that. So indirectly, revenues is inclusive of all expenses. No, revenues will be used to meet all expenses of the company. So my working capital is 25% of revenues. The working capital number is 25% of revenues of the company. And most of the times it's on revenues only. Now why I wanted you to calculate working capital separately is if you don't do this, 4th year you will add 8% and end up making a mistake. You will feel that 4th year working capital will go up, whereas it's not going up, it's going to come down. When I say technically coming down means overall amount doesn't come down, but the amount of increase, the working capital will go up, but the amount of increase which used to happen is going to slightly come down because growth has kind of come down. Beyond this, if I put 8% to this, beyond this 8% will work. 259 plus 8% if you do, it will work. But that first year of stabilization alone will have an issue. So that is why preferable to do revenues and working capital separately. Preferable to calculate revenues and working capital separately. The revenues number are, I'm adding 20% to it. Working capital is 25%. And incremental working capital is this year working capital minus the last year working capital. Last year was 7,500 into 0.25. 7,500 into 0.25. So this is also an outflow. And we get FCFF. Moment cash flow is calculated, problem is almost over. You see the huge difference between 3rd year and the 4th year. That's more because of that revenue falling and depreciation not being there, your working capital changing. So that is why it's always essential that you calculate the cash flow for the year in which stabilization happens. In this case, the stability will come from 4th year onwards. Till 3rd year, the growth is some 20%. 4th year, it stabilizes at 8%. From 4th year onwards, we are going to have stability in the cash flows of the company. It will stabilize at 8% growth. So be careful about working capital. It is not that if turnover goes up by 8%, incremental working capital will go up by 8%. No, overall will go up, but incremental may not look at that 8% number. Any doubts on the cash flows? This is the most important part. If cash flows are done, problem is almost over. Any doubts on the cash flows? Any doubts on the cash flows number? I need to put this in year cash flow PVF DCF format and get the value of the company. We'll have to put this data in year cash flow PVF and DCF format. I will have to calculate cash flows till the growth stabilizes. So if stability comes in 4th year, calculate till 4th year. If stability comes in 7th year, you will have to end up calculating for the 7th year also.
If interest percentage and interest calculation is given, we won't be subtracting it.
Ignored.
Firm thing,
Yeah, FCFF, I ignore it directly.
And if the question specifies that only for the debt we have to do, then we can subtract it.
No, so if they ask me equity valuation also, I'll do FCFF, get the value of the firm, subtract the equity number, subtract the debt number. Any doubts on this? Next, valuation of firm, year, cash flow, PVF, DCF. The discount rate is 15%. Year cash flow PVF at 15% and DCF. Year cash flow PVF at 15% and DCF. Year cash flow PVF at 15% and DCF. First year cash flow. From 4th year onwards, there's going to be a perpetuity because the growth is going to be there. So they have given a growth rate of 8%. So I'll have to value perpetuity the moment growth stabilizes. So my perpetuity value is 2680.13 divided by 7%. The important point is this is 3rd year and not 4th year. This will be 3rd year and not 4th year. Please take care of that. You will end up making a mistake there. It will go to the 3rd year and not 4th year. Because moment the stability comes in, I can value a perpetuity, and my perpetuity valuation is a year in advance. This area will become very tricky. I repeat even 20 times, still normally students end up making mistakes. So be very careful about perpetuity part. It has to be valued a year in advance. I will have the cash flow in 4th year, 5th year, 6th year. Every year I will have the same. It's a growing perpetuity. It can be a growing perpetuity or a stagnant perpetuity. In a growing perpetuity, the formula is D4 by KO minus G. It's KO here, it's not KE. KO minus G. D4 is 2680. The D4 can be FCFF4 also. You can keep changing the formula. FCFF4, EPS4, FCFE4. So the cash flow of the 4th year is 2680. I divide it by 15 minus 8. This will be the answer. 28871.01. Some up down rounding off can be there. Let's not worry about that. Overall broad answer is 28,871 crores. The important part is whenever you value a perpetuity, please take care of valuing it a year in advance. That alone, please take care of that, because that will have a huge impact on your solution. Okay, and one more thing, if the question has given these factors, follow the factors given in the question. If they give you a 4-digit factor, follow them. If the problem is silent, then you calculate 3-digit factors. If question gives you some factors, follow them. Institute had deducted marks for one certified copy which I saw because the factors were not followed. So please follow the factors which are given in the question. If it's a 4-digit factor, because that will have a slight variation in the final answer. So if they give you those factors, copy them as it is. Sometimes they'll give you 2-digit factors. So please follow whatever is given in the question. If problem is silent, you can compute a 3-digit factor and then write them. Okay, let's do one problem on net assets method. Go through question 9. Go through question 9.
The question, if you're saying that even without strategy, like if we have to implement the strategy or not, we will just take the path and we will divide it by three.
Which question?
This one.
This question is not talking about any strategy.
Not talking.
If at all they don't give any, if they say this is a new strategy and there's an erstwhile strategy, it's only packed by, if there is no growth. Sorry, in that question PAT will not work because your capital expenditure and depreciation is different. The question has given different number for capital expenditure and depreciation. But the amounts are different, no? Capital expenditure is 600 crores, depreciation is some 750 or something.
But that is already included in the operating.
So PAT, add depreciation less capex. When you do, if both have to be same, no? There the ratio was to remain same. Let's do question 9. Okay. In this, I'm going to do net assets method as well as earnings capitalization method. Net assets method is, it's very simple. Instead of writing this to be 40 lakhs, I'll write some other number if they give me extra data. It's not 80, it's going to be some other number. Similarly, it's not 10. The values will undergo a change if I have extra data. All assets minus current liabilities is the value of the business. In that value of the business or value of the firm, if you deduct debt, you will get the value of equity. So all assets minus current liabilities will give you something called as capital employed, or technically called as value of firm. From there, if you deduct debt and preference, you get value of equity. Working note 1, computation of share price. Computation of share price on net assets method. Computation of share price on net assets method. Share price on net assets method. Particulars. Particulars and amount. Particulars and amount. Whatever we have done in mutual fund chapter, the same thing will work. First are assets. You will end up capturing the assets. Land and building. Look at if you have any extra data, change the value, otherwise copy them. Land and building. How much they mentioned? 96. Plant and machinery. 100. Stock is, nothing is mentioned on stock. 10. Debtors 15. Cash at bank 5. If they give some extra information, we consider them, otherwise we write the numbers which are given. Land and building, plant and machinery, stock, debtors, cash at bank. Sometimes they may talk about some contingent liabilities and all. If they give you that, you will have to take that also into consideration. Total assets / value of firm. I don't have any liabilities in this question. total assets slash value of firm. That is also, that is not a liability, that's part of capital employed. So total assets slash value of firm. From this, if you deduct debt, then you get the value of equity. So this will come for valuation at a firm level. Value of firm is 226. Value of firm is 226. Basically, I'll have to deduct any current liabilities. If current liabilities are not there, what I get is directly the value of firm less long-term debt, and I'll get value of equity less long-term debt, and we'll get value of equity. Long-term debt is 30 lakhs and value of equity is 196 lakhs. Long-term debt is 30 lakhs, value of, we can get the price per share by dividing it by number of shares. Price per share 19.6. 196 by 10, 19.6. The price per share will become 19.6. Any doubts in this? This is based on net assets method. We have multiple methods of valuation. Net assets method says 19.6. Then valuation as per earnings capitalization method. Valuation as per earnings capitalization method. Basically, we'll have to do something like this: past PBT, less add certain adjustments if it are there, and finally get something called as future maintainable profit after tax. So that's the approach we are going to use here. Now when it comes to the question, this is profit for the current year 64 lakhs includes. Now my first assumption is whether the 64 lakh is PBT or PAT. That's an assumption you have to take, and based on the assumption your answer will change. We'll take it as PBT, not sure what is done at the institutes, but whatever is the assumption, you will have to write a note on that. It is assumed that 64 lakhs is profit before tax. It is assumed that 64 lakhs is profit after tax. So let's take this as past PBT. Past PBT 64, past PBT 64, past PBT 64, some extraordinary income, all this we'll have to deduct only, less extraordinary income, less extraordinary income 4, because this is not going to happen in the next year, so profits will come down. Surplus investments income, again we'll have to subtract it because the 64 lakh includes this. This is not going to happen in future. In future you are not going to get this two incomes. So because of this line itself, 64 will come down. 64 included these two incomes, less income from investments 1 lakh. These two items are now going to come. Income from investments 1 lakh. I'm going to incur some additional advertisement expenses in future. It's not talking about the past. Some question will say in the past we have incurred an expense but not to be incurred in future. Then it's adding back because in future you're not going to incur this. But this is also an extra expense for me. This is also minus. I am going to incur some extra expense, so my profits will automatically come down. Less advertisement. This is an extra expense, less advertisement, which is 5 lakhs. And also another expense called as additional depreciation. Additional depreciation 6 lakhs. Future maintainable PBT. This is the future maintainable profit before tax. Future maintainable PBT. future maintainable profit before tax, less tax and FMP. Taxes future maintainable PBT, less tax, and you get future maintainable profits. I'll divide this by that capitalization rate. Capitalization rate, how much they've given? 15%. My assumption is this whatever PAT calculated, this does not include any interest deduction. That's my assumption, with which that's what institute has done. If I assume saying that interest is already deducted, then what you get is value of equity, because the entire money which is here will go to equity shareholders. If it entirely is going to equity shareholder, that's their own value. If interest is yet to be deducted, then this will go to equity as well as debt holders. So institute has taken that assumption. They have deducted debt at this place. Beyond this, it is like this: less long-term debt, value of equity, and price per share. Less long-term debt, value of equity, and price per share. They have taken this assumption. I can take another assumption saying that this PAT, whatever number I have, will go entirely to equity shareholder. Then I directly get the value of equity. The PAT number, if it is going to equity shareholders, then we directly get PAT. So then we directly get value of equity. Now they ask for fair price. They have asked us to calculate under net assets method and earnings capitalization method. Fair price is average of these two. Some question will give some weights also. They'll say 3:1, 4:1 weights. If they give you weights, follow them. Otherwise, just add both and give equal weights to both. We'll end up adding and then dividing it by 2. Any doubts in this? Try question number 10. Try question number 10. The fair price is average. The fair price is average, which is 19.5. Do question number 10. this will be the value pre-merger. If you take the pre-merger cash flow, the only important part is this. The perpetuity valuation is year 6 cash flow divided by cost of equity minus growth rate, and that amount will be written in the 5th year. You will take the 6th year cash flow, you will divide it by cost of capital or cost of equity minus growth rate and write that amount in the 5th year. That alone you will have to take care. So the amount has to be written in the 5th year and calculation will be done based on 6th year cash flow. When it comes to merged, 400, 450, 525, 590, 620, and then the growth changes here. It becomes 6% and denominator will become 9%. The growth changes to 6% and denominator will become 9%. And accordingly we get a value of 5308. So the only important point is please pay attention on the perpetuity valuation part. It has to be valued a year in advance, and when you are valuing it in the 5th year, you need the 6th year cash flow. And perpetuity can be valued only if the growth stabilizes. You say different growth, you cannot do it. Till growth stabilizes, perpetuity cannot be valued. Moment stability in growth comes in, you can end up valuing a perpetuity. Any doubts in this?
We don't add 520 plus 5%.
620. Which number?
3675 perpetuity calculation. We've added growth on the numerator also.
Yeah, you have to know. You need 350 plus the growth rate. It is formula is P5 is equal to D6. You need the 6th year cash flow, no?
I got 350 by 10%.
350 by 10% you cannot do because 350 is the 5th year cash flow. You need the 6th year cash flow to value the perpetuity.
Yeah, my growth is stabilizing.
Which year the growth stabilizes? 6th year it stabilizes, so you value it in the 5th year. To value it in 5th year, what is Gordon's formula? P naught is equal to what?
P naught into 1 plus G.
D1 by K minus G. So if you want P5, you need D6. If you want to value in 5th year, you need the 6th year cash flow. That's the rule of perpetuity valuation. Any doubts on this? So this will be the value pre and post merger. Value of acquisition is nothing but the difference in value 5308 minus 2708. This is the benefit of the acquisition or the value of acquisition. Because of acquisition, the value goes up by this number. Value of acquisition 2599.55. Basically, whatever entity I am acquiring, I see a worth of 2599 in that entity. I see a worth of 2599 in that entity. That's the value of acquisition. 2599.55. That's the worth of acquisition of the other entity. They've asked for gain to shareholders of S Limited. That is, S Limited wants to acquire No Limited, and the cash flows of S Limited and the merged entity are given below. I want to know what is the gain to S Limited. They're not asked for No Limited because I don't have the value for the No Limited. Listen, if I have to calculate gain, I need this. Particulars, I'll need the overall value. Pre-merger, what is the overall value? Post-merger, what is the overall value? If I have these two, I'll get the gain to the shareholders of S Limited. Now, before merger, the value is 2708. Post-merger, the value is 5308, but I don't own the 100%. I own a lower percent. So I cannot say that because of merger, my value, the shareholders' value is not going up by 2599. It's only the company's value which is going up, because when it goes up, you allot extra shares. Now, reading the question, can you tell me how many, what will be the percentage holding of S Limited shareholders in the merged entity? Merged entity, what will be the percentage holding? 1 by, so today I am owning, let's assume both the companies have only one share. So I am owning 100% of one share. After that, what will happen is, on top of one share, another 0.5 will get added, because we have to allot exchange ratio of 0.5. Shares is same. So let's assume 1 lakh and 1 lakh are the shares. You will allot 50,000, so it will become 1,50,000. So post merger, Post merger, I will own 2/3 of the company. Post merger, I will be holding 2/3 of the company. Pre merger, I own 100% of the company. So next, gain or loss calculation. Gain or loss calculation. I cannot do this calculation for no limited because I don't know the value of that entity. We have not been given any data on what is the value of the other entity. So without that, I cannot calculate the gain or loss for that entity. Gain or loss computation, particulars, amount, pre-merger value, post-merger value, and gain/loss. Pre-merger value, post-merger value, gain/loss. Pre-merger is this, post-merger is 2/3. It basically, I'll own 2/3 of the company. Moment the merger happens, I'll be holding only 2/3 of the company. Before merger, I own 100% of the company. After merger, still there is a benefit for me. The benefit is some 830 lakhs. That's the benefit I have in the exercise. I own 2/3 of the merged entity, and pre-merger I own 100% of the entity. So before merger we own 100%, and post-merger it's only 2/3 of the entity. Any doubts on this? Similar calculation I could have done for no limited. See, no limited I can tell post-merger their value is this. Post-merger their value is 1/3. But pre-merger value I don't have. That data is missing in the question. Pre-merger, what was the value for the other entity, we don't know. Post-merger, I can say they hold 1/3 of the company. So if you give me pre-merger, I'll write that as well and calculate the gain or loss for them. We'll do one more problem in this and then take a break. Okay, as far as valuation is concerned, they have tested 2-3 times question on financial restructuring, which I am not covering. Financial restructuring is nothing but your internal reconstruction, which you could have done at inter level. So they have asked questions on internal reconstruction. May 2017 exam question was there. Again, they tested one more time. Just a minute. Okay, it had come in November 2018 RTP. So I'm not sure why they are testing it, but restructuring, which is part of your accounting, it's purely an accounting area, nothing related to what we are doing in valuation of business. So somewhere it is getting tested. So maybe you can go through that sum to understand what happens in financial restructuring. It's technically internal reconstruction. Let's do one problem on wrong WACC. Let's just do. Okay, let's do this question 22. Go through this question. Go through question 22. Okay, now listen. The valuation of Hansen Limited has been done by an investment analyst based on an expected cash flow of 54 lakhs and a growth rate. Analyst has estimated the value of Hansen Limited to be 800. He committed a mistake by using book value of debt and equity. Book value weights are not known. Some data on cost of equity, cost of debt is there. They've asked us to do the correct value of Hansen Limited. Now, when I do a valuation based on cash flow, I have a formula called as FC. It's basically D1 by KO minus G. D1 is FCFF1 divided by cost of capital minus growth rate. I know the value, I know the cash flow, I know the growth rate. With this, I'll get the wrong WACC because he made a mistake of using the book value As a concept, we use market value. We prefer to use market value. So we will get the wrong WACC. Based on wrong WACC, you will get to know what were the weights used, and then we'll rectify the weights, use the correct WACC, and then get to the answer. Working note 1, computation of WACC. Computation of WACC used by the analyst. Computation of WACC used by the analyst. Computation of WACC used by the analyst. WACC used by the analyst. Value of firm is equal to FCFF0. Value of firm is equal to FCFF0 divided by KO minus D. FCFF0 divided by KO minus D. The figures are there in the question. Let me know the KO. FCFF0 divided by KO minus D. Divided by KO minus G. Value of firm FCFF0 by KO minus G. Value of firm is 1800. So this is FCFF1, okay, 54 by KO minus G. KO minus G is 0.03. Growth was some 9%. (54) by KO minus G. KO minus G turns out to be 0.03. Growth is 0.09. Growth is 0.09, 9%. Growth is 0.09. Value of firm is equal to FCFF1 by KO minus G. 1800 is equal to 54 by KO minus G. KO minus G is equal to 54 by 1800, which is 0.03. Add 0.09. KO is equal to 12%. KO is equal to 12%. Clear? Any doubts in this? Next, computation of weights used. Computation of weights used. Source, cost, weight, product. Source, cost, weight, product. This is the format to get any weighted average. Source, cost, weight, product. Source, cost, weight, product. Source, cost, weight, product. Source, cost, weight, product. I have equity, we have debt, and then finally we have firm. Equity, debt, and firm. The weighted average of equity and debt is the firm, which is cost of capital. The weighted average of equity and debt will turn out to be firm. What's the cost of equity given? 20. Cost of debt is 10. Firm is 12. Now I don't know the weight, so I'll write this as W1. This is 1 minus W1 and it will add up to 1. The weights of debt and equity is W1 and 1 minus W1. The weights are W1 and 1 minus W1. W1 and 1 minus W1. Second column into third column is fourth column. So 20 W1. 10 minus 10 W1 is equal to 12. Second column into third column is the fourth product. So 20 into W1, 10 into 1 minus W1 is equal to 12 into 1. Is equal to 12 into 1. That's the firm's total. You will get to know the W1 and W2 in this, or weight of equity and weight of debt. You will get to know what is the weight of equity and weight of debt. Weight of equity and weight of debt. weight of equity and weight of debt. How much? 20% and 80%. So this is what he had done. Now this will give you a wrong WACC because he has used wrong weights. This is what the person had done when he did the valuation. You got that 12, 4 plus 8, 12. This is what he has done. Any doubts on 20 and 80 weights? I'm going to use this data and get the right WACC. Listen, this 20 and 10 will remain same. The weights now is, they are saying the book value weights are not known. The value of equity is thrice its book value. The value of equity is thrice its book value. So listen, I do it in a way that the weights will not add up to 1. I'm not really bothered about it. Even if it does not add up to 1, you will still get the answer. So what we will do is, earlier the weight was 0.2. Now the weight is 0.6. Thrice. It is 3 times of that. And the value of debt is 9/10 of its book value, which is 0.72. It is 0.72. The rule is, at any stage, the second and third column multiplication will be the fourth column. So here you will end up dividing now. The moment you divide, you will get the overall firm's WACC. So it need not add up to 1. Equity, earlier it was 20, 80, equity and debt. Now it is 60 and 72. It is 60 and 72. Many authors say that it has to add up to 1. When you have to make it to add up to 1, you will have to do certain adjustment. Net, you will get the same answer of 14.54. What you will end up getting is 14.54. Whether it adds up to 1 or if it adds up to 1, you technically don't divide because division by 1 is same. It doesn't add up to 1, so I'll have to divide by 1.32. I'll have to end up dividing it by 1.32. At any stage, the second column into the third column has to be the fourth column. So that rule has to be maintained. Now we'll have to use this WACC and get to the answer. That's all. The final part is that instead of using 12%, we'll have to use 14.55%. Other parts will remain same. Your cash flow will remain same. Growth will remain same. Just that WACC was a wrong WACC used. Yeah. Which one? It need not add up to 1. It adds up to 1.32. If you want to add it up to 1, then you will have to say that 1.32 is equal to 1, 0.6 is equal to what? So I'll have to do divide by 1.32. I'll have to again divide by 1.32. No, not the cost. It's only the weight. You can make the weight add up to 1 if you want. But that doesn't serve any purpose. Net, it's just an extra calculation. You'll end up wasting time on that. In effect, I'll get the same answer of 14.55. The answer is going to remain 14.55. And my value of firm now is 54. This will be the value of firm. Earlier we did 12 minus 9. Now we'll have to do 14.55 minus 9. This is because there was a wrong WACC used. Now we have corrected the WACC. The value will undergo a change. Yeah. The growth is already considered. They've said no expected cash flow of next year. For the following year. Growth is? Yeah, it's already included. It also depends. They've said for the following year. Sometimes say the cash flow. Yeah, the more or less the word expected takes care. The answer is 972.97. We'll take a break of 30 minutes and then I start with Forex. So I'll start with Forex post break. So we'll take a break of 30 minutes now.